Good evening and welcome to Traders Group. I'm hoping that everyone that was in the room last week, I did start to mention that something was not quite right with the markets, and I put some trigger levels on screen which would confirm, the worry beats that I were starting to play with, and that was that the market looked like on the Dow and a lot of sectors forming M tops, and it hadn't actually broken trend last week, but on the Friday it did, and also not only did it break trend, it confirmed an M top on the S&P 500, and that was why you received that recording on the Friday, just to make sure that the urgency was transmitted to you in a reasonable, speed, at a reasonable speed. So what I'd like to do this evening is to start with answer a question that I've been asked, and it's by an institutional client. The question is, if the market continues on down, how far? And the question's really centered around building a hedging program for a fund, and what they're looking for are technical boundaries on screen, and an upper and lower boundary to give them a sense of how far they should continue to hedge the portfolio, or for how long. So let me do that this evening. It's interesting. Hopefully it's interesting, and it starts with a template. Okay, Alan just put in a comment. He said, thanks, that was great. And he stopped some buy orders. Fantastic, Alan. Money not lost is money earned, I suppose, money saved. So did a lot of other people, by the way. I got lots of thank yous. And just for the record, I'm 100% hedged. So I've got zero exposure to the downside, just for the record. So let me just focus in on this, and I'll get and answer other questions in a moment. Looking at the 2008 high, that's what you've got on the screen. I want to use it as a template to build a forecast to the downside for the present market. And I need some information off this screen to allow me to do so. So the first piece of information off this screen is the first range to the downside, and then the rally, and then the M top, which was a lower high. Okay, so we all agree that that's pretty, pretty obvious stuff. And I think I may have done this last week. We noticed that the market did on the first retracement, a 0.618 pullback, did a lower high, and then confirmed. Okay, so that's all a given. Okay, so let me just get rid of the revision, because that's not what we're interested in. What we're interested in is how far the market can fall. And the first piece of information I'd like to use is the previous range, and that was the range that started on the 11th of the 10th, 2007, down to the bottom of the range, which is on the 26th of the 11th, 2007. Capturing that range, I'm now marking the screen to the downside, and I would have you note that the market didn't quite reach 0.618. For a market to fall and reach 0.618, there needs to be a really nasty fundamental, and although the market was pretty ugly, it didn't quite reach it. So that 0.618 on any forecast represents an absolute extreme of price movement, and on the downside would constitute the lower boundary of a price projection on screen. So just take note, 1.618 is my lower boundary, and I'll be using that lower boundary in the real market. I need to work out an upper boundary, and my upper boundary is calculated by the percentage shift of downward movement in 2008. So is it likely that the current movement will be replicated in the context of the same percentage? Well, that's crazy. Why would it be? Because the different fundamentals are driving the market, but I still need to build some sort of framework to give me a sense of an upper and lower boundary. So what I'm going to do is I'm going to use the range of the fall within this market. That is, the higher the M top, so the lower the fall. So I'm just going to draw that up on screen. It's in my way, so I need to delete it. The high of the market was, at that point in time, was 1523. The low of the market at that point in time was 1270. The difference is 253.4, which represents a 16.61% fall. So from high to low, it's 16.61. Okay, so with that information, I'm now going to transpose that information or that framework across to actual markets. Just give me one moment. I just need to drag my screen across. Okay, so it just takes me a few moments to do so. Okay, so here we are in the current market, and I'm going to use the same thinking to calculate an upper and lower boundary. So remember how I calculated the lower boundary? I'm going to use the range from the first fall from high to low, just put on screen. Then I'm going to delete it because it's in my way. I can't really see the numbers precisely. So grab my tool, grab the higher the range, and I've grabbed the wrong tool. Starting again, grabbing the correct tool, grab the higher the range, grab the lower the range, and mark it down for the highest point of the M top. And I want 1.618 extension to the downside of that range. Okay, so let me just mark that up on screen. That 1.618 would represent the most extreme boundary to the downside in my view. Okay, so let me mark that up with a thin blue line and go back, and I could now delete the Fibonacci information because it's not required because I've left the blue line on screen. Okay, the second piece of information I want is the upper boundary. Now the upper boundary, I'm going to use the same percentage fall in the 2008 fall. So the range of, the high of this M top currently is 2802. Maybe not to the to the cent, but 2802. If I mark down 16% from 2802, it gives me in points 465 points, and 465 points taken away from that high is 2337. So I just want to go and mark up now 2337, and I'll have all my information to do what I need to do in terms of a forecast. Just give me one moment. Just grabbing my tools. I want to mark it up. 2332, 2333. I'm just doing it very carefully. Just give me one moment. It's really hard. I need to increase my scale to get this exactly correct. Let's do it again. Okay, so I want to put up 2337. So that's 2, 3. Just give me a moment. Nearly there. I feel like I've done something wrong here. Just give me one moment. I seem to have got an extra line on my screen. Just give me 1 moment. I'm just going to recalculate something. Always the case when you're showing something live. Okay, I'm just going to grab the high and low range again. Correct. Okay, so that's correct. Okay, I'm just going to put that was my lower boundary. And I just got a sense that my upper boundary okay, I've got it. I just was making a mistake. Just give me 1 moment. I don't know where that blue line, I had an extra line on screen, it was confusing me. 2,335.37. There it is there. Okay, finally I got it right. Okay, done. Okay, Kirsch, thanks for the information. Okay, so what have we done so far? Sorry for the sloppiness. I've done a lower boundary, which is 1.618 extension to the downside of the range at the top of the screen. And then I've done another thin blue line, which represents a horizontal thin blue line, which represents 16.61% from the top of the MTOP. So that's my upper and lower boundary. There's one other piece of information on this screen which is important, and that's the big fat blue line angled up on the screen. Where on earth is that coming from? Well, let me just come across to a monthly chart, and it's pretty damn clear where it's come from. It's a trend line of best fit from the low of 2009. And Richard has talked about this many, many times, and I always pushed him away and said, I don't think this is possible. But now I believe it is possible. I just want to make a point with lines of best fit. You can draw trend lines any way you like. I could have drawn this trend line which touched the extremities of these declines where there's only two, or I could have drawn a trend line of what I call a trend line of best fit, which touches most of the falls within the market. And I like the trend line of best fit. I think that represents a more accurate representation of trend, because the market obviously punches through a couple of times that trend line on extreme news, but it's not the trend line of best fit. The trend line of best fit is exactly what I've got on screen. Okay, so just an explanation of why I did what I've done. And now there's something pretty damn interesting on screen. The trend line of best fit coincides with the upper and lower boundaries. Now with that upper and lower boundaries, I'll come back with a daily chart now that you know what the big fat blue line is. And we can see that we've got ourselves a target on screen, which the best or the least decline probably, if the market starts to fall, probably will continue on down to the blue line. And if it punches through, if it does something really extreme, it'll get to the lower boundary, which is the 1.618 extension. So it is a kind of a coincidence that the 16% fall coincides with the long-term trend line. And you've got to ask yourself, is that even possible? Well, I could do a poll right now. Is that possible? Of course it's possible. Anything is possible. So this is essentially a framework for a fund manager. If they want to hedge, what they want to know is, if they're of the belief the market's going to continue on going over, how far? And if it's how far, they want a sort of a tram track, a range. No one can get it exactly correct, but I think that is not unreasonable, that forecast. Okay, so I'll stop there and I'll just get rid of the information that I don't need. I'm going to leave those three lines on screen for obviously the next few weeks, and we'll see how this unfolds. I am of the belief that this market will continue on down. markets, that said, markets don't just fall. And last week when we were in the room, we were looking at this market, and what we did notice, or what I did put up on screen, was a trend line which represented the trend that the market was in at that point in time. Now, Barry, you've just entered the room and you're a little bit late, so I would strongly recommend that you listen to this recording. I've just spent 17 minutes doing a framework for a portfolio manager to hedge his portfolio with downside targets and the justification for the targets. So, please have a look at that on the recording. Okay, so last week where we were, and I'll pick up, Alan's got a point that I think is not unimportant. I'll put it up in a moment. There is, we were looking at a break of trend. The market actually hadn't broken trend, if you recall, last week. And Thursday evening, it did. And that's what was a trigger for me to hedge my portfolio. So I have, as I already said, zero exposure in this market, zero. So this is the second time I've hedged this year. If you remember, I hedged up here, I re-entered the market here, and I've now had to hedge again. Did I want to do that? Of course I didn't want to do it, but I would love the market to be screaming to the upside and making $1 million. But the fact is, I'm analysing, reacting to a market in real time, and not doing so is the recipe for poverty. I'm actually more interested in the protection of capital than I am in capital growth. Capital growth will come sometime in the future when the market stabilizes, finds a low, and takes off again. In the meantime, you've got to protect your capital, and that's what is the prime directive, stealing that from Star Trek. It's the prime directive for everything I do in terms of portfolio management. So looking at this market, often markets don't just fall. What they do is they do a 3 or 4 day counter trend to the upside, which can be a time correction. And I think that's what we're looking at. It's a 3 to 4, up to a 5 day sidewards or upward move, which would be the MA pattern, and then the market falls. So if there is to be a capitulation in this market, I think you would have to expect it obviously sometime after Easter. And interestingly, if the market gets down to the lower boundary I just built on screen, it's going to have to be a very large fundamental. You know, it's going to be significant. It's going to be, probably won't be North Korea. They've calmed down. It'll probably be Russia's response to the expulsion of diplomats. What else could it be? It could be China ramps up its retaliation for, you know, the context of trade wars, or it could be something that we have got no idea what's about to happen. That's why do the markets work like this? I got no idea, but the markets are setting up technically for a much bigger fall, and that is a true statement, which is supported by a massive increase in institutional selling volumes in the past week. What would dictate us being wrong? Well, it's not about right or wrong. If the market started to accumulate, break above its moving average, do a series of high highs, and start a trend to the upside, well, that's called accumulation, and you'd switch your view. But at this point in time, the market is going down. Market has done a double test. And as I said last week, the Dow Jones was the first thing to alert me to this. And then when I started to look at other sectors, it started to look a bit strange. I'm just going to put up another moving average that Alan's asked me to put up. Just give me one moment. So just give me 1 sec, just inserting a second average on screen. And this one's going to be a 200 period moving average. And I'm going to make it exponential, so it's sensitive to the markets. And we're having a look at it. Okay, so I'll now read Alan's comments out. Alan said fund managers use the 200 MA for their check on market direction / breakthrough. And Alan's quite right. The 200 period moving average is at this point, acting as a level of support. And as that support, if it does get broken, will add more weight to the potential that the market could reach one of the two boundaries drawn on screen. So it is an important consideration, and it's just a lot slower than any other tool that you could use, but would be a good confirmation tool in which to solidify your view of what's happening in this market. I've already made the point that volume behavior is completely reversed dramatically with a massive spike in selling behavior, and that it would be a true statement for both the internal measurements that I take and also just general volume behavior. In terms of the general internal measurements that I take, which are advancing and declining stocks, there is a really big shift this week. Last week, there was 3 weeks ago, there were 269 advances, 222 decliners. Last week, it started to drop off reasonably heavily. 241 decliners, 248, 241 advances, 248 decliners. And this week, it's dropped really strongly down to 200 advances and 291 decliners. So there is a fairly big trend in terms of the numerical number. And there's also a big shift, and I haven't seen this for a while, and that is it's the volume of the advances and the volume of the volume numbers against the number of stocks that are advancing and declining. And for the first time in a long time, I'm observing the declining volume is, I should have worked it out as a percentage, it's about, I'm just guessing here, it's about 40%. I've never seen this before. It's about 40% greater, that is the declining volume is 40% greater than the buying volume, and I haven't seen that imbalance for quite a while. What's the significance of that? We're about to find out. In terms of new highs, new lows, last week, or 2 weeks ago, there were 24 new highs, 7 new lows. Last week, there were 23 new highs, 5 new lows. And this week, it's jumped off a cliff. There's 5 new highs and 14 new lows. Just give me one moment. I just need a quick drink. I'm losing my voice. Okay, so I'm just picking up some of the comments on the screen. Okay, Alan was just adding to the 200 period moving average discussion. I wasn't watching the screen, and he said, just to add to the story, that he was using a 125 period MA for confirmation till it broke through. So I suppose the key is, how long do you wait for confirmation? Well, I don't wait any longer than I've described to you in the last 2 weeks. That was a breaker trend, confirmation of MTOP, and an increase in selling volume. Okay, I've done 25 minutes on that, but it was important to do so because there are people reacting to the information I'm giving, so it's important. So where is this market going in the short term? Probably up. We're into Easter. I'd be surprised if it went down tonight. People have already disappeared for Easter holiday break, and it actually does affect the market. So it'll either go sideways, slightly up, and sometime into next week we'll see the market start to break to the downside. And remember, that has to be driven by something that we don't know, because everything that we do know is already impacted within the markets. Let's go have a look at the IWM, other markets around the world. But before I do that, sorry, I'm going to pick up the Dow, which I very rarely look at. But remember, I showed this to you last week. I showed you this is a lower high, and it's very confusing. Well, I'm not confused anymore. So the Dow was the one that alerted me to the potential issues. We'll go have a look at some sectors at the moment. IWM is quite strong, and I couldn't call it an M-top. I could barely call it a break of trend, but it won't resist what the rest of the market's doing. Let's come across to international equity markets such as the Shanghai Composite. First of all, look at the Shanghai Composite through FXI. And in the last few weeks, I've been drawing, and I've left all my drawings on screen. I'm just going to get rid of that 200 period. Actually, I'll leave the 200 period there. I've been drawing squiggles on screen with the expectation of seeing a higher low. I have mentioned in the last few weeks, I'm a bit confused that the market hasn't confirmed. For a accumulation pattern to confirm, it has to cross its midpoint, and the midpoint, as we know, it's the previous swing high. It didn't do it, and it failed, and now has crossed the previous swing low, indicating failure. And that is, we've done this many times. Drawing W patterns, they have to confirm, they don't confirm, warning signal, start to fail, break previous swing lows, change of trend. So what this pattern is in the process of failing and illustrating the potential for failure, ongoing failure. Coming across to the Shanghai Composite. Shanghai Composite has absolutely dumped in the past week. If I gave you volume numbers for FXI and things like EWG, it's across the board. All institutional selling volumes have dramatically increased, buying has disappeared, and the market is doing what it's doing. Coming across to the DAX, first of all, let's look at EWG, which is the German index traded on NYSE. Once again, I was drawing W patterns, and even I've got the line where I would have been saying, but it hasn't crossed its midpoint. Until it crosses its midpoint, it's not accumulation. It's not confirming accumulation, and now we can see failure of accumulation occurring, not only not reaching its midpoint, but also crossing its previous swing low, which is the market setting up failure. Interestingly, these W patterns that look like Ws are often, I think I mentioned this last week, are the left-hand shoulder of an inverted head and shoulders pattern. I haven't drawn any of that on screen because it's a little bit premature. But if we do have a big move down, it's not unlikely that the market will look like this. And then the market has a sharp rally. I won't go any further because it's jumping the gun. But that's how they form up. I did draw that on the on XJA last week. That if it did fail, it'll probably be a big inverted head and shoulders pattern. That looks like what is actually occurring. Hasn't happened. DAX. This is the actual DAX. The DAX is just a mess. There is no pattern to even get your brain around. Market just continually does a series of lower lows, lower highs. I'm now going to start to delete some of the information on screen because it's all irrelevant. And this particular market, using the 200 period moving average, has been below there for an awful amount of time. Just reading out Alan's comments as I'm talking. Alan's just making a very good point that we're in a period of high volatility now post-January, large daily swings compared to previous Januaries. True statement. And the low volatility, low VIX moving market that we experienced for the last few years, even with Mr. Trump getting into power from the 8th of November 2016 to the recent high, that's all gone, finished. This is a normal market. Low volatility, upward, slow grinding upward markets, they're not actually normal. This is a normal market where you've got to be really good at what you do. And in the last few weeks, it's an example of you've really got to be reactive to the market. Or the only other thing you could do is stick your head in a shoebox and pretend it isn't happening. That's the only thing you could do, because it upsets you if you're not active or proactive, you just gets you upset. So let's come across to EWA. EWA is obviously XJO on NYSE, and it looks exactly the same as the other indices around the world, the S&P 500 and the Dow. We've got a lower high, confirmed M top, looks like it's going down, supported by a dramatic increase in the last week in institutional selling volume. Coming across to the Australian actual index, XJO, putting that up on screen. I really can't remember what I drew up on screen or not. I may have drawn this up when I did the recording, but let's just I'll just leave it as it is actually, because I've done a projection to the downside, which I'm going to leave there. I haven't really I should have looked at this before I come online because I was focused in on the S&P 500. But if this market does continue to fall, it will be an inverted head and shoulders pattern if it has a steep decline. I've just projected down to the 100. If we get a really deep decline in the United States, obviously it can go a lot further. It could be a 1.618 decline, and I could do a little bit more work on this for next week because I've got all these lines on screen. Just give me one moment. I just want to convert across to a monthly chart, see what I've been playing with. Okay, that big fat blue line on screen is the trend line of best fit from the 2009 low, and it coincides with a 1.618 extension to the downside of last week's forecast. Now, last week I didn't sort of even consider that's possible, but markets tend to gravitate towards an average rate of change in price, and it has been quite out of whack, both in the United States and Australia. Therefore, is it possible for markets to come back to long-term trend lines? Well, you already know the answer. Of course it is. So is it out of the realm of possibility that we could have a market coming back, not to the first level of support, which was the 100, but to the second level of support, which is the blue line and represents the 1.61 extension? Of course it is. By the way, this makes me very, very happy because this is just another buying opportunity. At one of these points, we're going to find a major low, and the market will roar back unless there's something very negative that we don't know about. Therefore, this is a period of, for me, it's a period of happiness. It's a period where I wait in anticipation of finding this low based on price pattern and volume and re-enter the market. Because remember, I am 100% hedged, so I'm just sitting there with plenty of cash to throw at this market when it gets to these levels sometime in the next few weeks. Okay, I think I've done enough on indices. Let's go track across to other interesting things. Probably the most interesting thing to me are actually currencies. Not that I am a currency trader, but I just need to slow down. I'm going too fast. I still got to stick with equity. Sorry, I'm moving too quickly because I was spending so much time on that first section. I just want to jump across to the VIX. Looking at the VIX on CBOE last week, I made note that the equity market was in an uptrend and the VIX index was in a downtrend, and it had not broken out of its current channel. This has all changed in the past week, where the market has broken out of its channel and is now doing a series of high highs and higher lows, which is a general increase in fear of the VIX. Just jumping across to, I should look at the Australian VIX to see if it says a similar thing. One moment. Here we go, XVI-ASX. Okay, I need to contract up this chart. So looking at the current Australian VIX, it's basically done a very similar thing. Last time we were focused on this chart, I was pointing out a series of increasing higher lows. This was before the fall in Feb, and here we go. The market is doing a similar thing. It has broken its short-term trend, and there's an elevated level of fear, obviously, within the Australian market as it falls, and that big bar to the upside was probably the best indication. Before I get onto gold and other things and currencies, I just wanted to shift across very quickly, sticking on equity markets, and just have a look at some of the sectors. Primarily the US is the easiest to read, and just have a look at some of the stronger sectors. I am very interested in tech, but tech is getting a really bad rap at the moment due to what's happened with Facebook and in terms of breaches of information security. So there's a bit of talk that tech's had its run. That remains to be seen. You know, everyone can easily make a comment based on one fundamental. Tech has been and potentially still is the strongest sector in the market. Yes, it's had a bad rap with a few things in the past week, and has broken trend. There's no end top on screen, because it was the strongest sector. All other sectors have got M-tops, and those M-tops have confirmed. I don't care what we look at. Look at consumer discretionary, perfect M-tops, and they're all confirmed perfect M-tops. Just coming down the list, finance, perfect, confirmed M-top. Industrials, perfect, confirmed M-top. It's not very often you can say that the whole market has got perfect confirmed M-top in healthcare. XLB, perfect confirmed M-top. XLE, energies, not really an M-top because it didn't really rally. So it's just a failure. I can force an M-top on there, but it's silly. XLP, M-top confirmed. In fact, this is an MA pattern. Why is this chart significant? This chart is significant because it represents the weakest sector in the current markets. If I was looking for a short trade to buy puts, I would be looking within the consumer staple sector within the United States. It is a weak sector. Weak sectors usually have the biggest fall. Alan, as I'm talking, just put in, how about utilities? It's normally a savior in a downtrend usually. So Alan, be careful when we use the word downtrend. We're not talking about a long-term downtrend. What we could be going through at the moment is a short-term corrective phase, just a pullback in the markets. It's not quite a pullback. Pullback's just a pullback back to a trend line. A correction, breaks the previous trend. So it looks like it's a corrective phase, but you're quite right. If we were in a continued downtrend, the most defensive stocks are utilities, absolutely correct. And the next one would be consumer staples. Why? Because people need water and power, irrespective of what the market does, and we all need to eat consumer staples, so they are resilient if and when we ever had a downturn. So just coming across to the utilities chart, surprisingly, it's looking a little bit robust, and it will probably, in the next week, if the rest of the market goes down, what will this probably do? It probably will either stay stationary or potentially go up. That is well observed and quite well-known relationship. And the one that I don't like is telecoms. It's just all over the place. So anyway, just an interesting technical lesson on M-tops, and the majority of the market is obviously saying that. I probably won't go through the Australian market other than just checking out XMJ, material sector. I think you can look at these yourself because I'm going to run out of time. XIJ, maybe I will look at it. XIJ is one of the strongest sectors in the Australian market, and it's put in a top, just confirming today. XHJ is another strong sector within the Australian market. It's only just broken trend. XSJ, the staples, it looks like it's putting an M top, not confirmed, probably will confirm tomorrow. Finance, XFJ is just horrible. I'm just going to bring up a bigger picture of this. If the major percentage of the Australian market is made up of finance, what's the number? 42% of stocks make up XJO. How is the index going to go up with this in free fall? You know the answer. It can't. So the Australian market is going nowhere in the short term without the support of the finance sector, and also needs the support of metals and mining. Just give me one moment. I'm just going to clean up this chart. So this was in big picture. This was a big accumulation pattern that failed because remember the V. It only wants to pull back 0.5, 0.6 at most, and it went further. We have done this many times before. It's just played out on a really big time frame, and it's with a weekly chart. It's easy to see. It was. Back here, I would have definitely been saying, look, accumulation, broad-based accumulation, market starts pulling back. It needed to stop and break up. It didn't. It just kept on going and failed. And if finance is doing that, so is every other financial stock. Primarily, though, it's the banks. There are opportunities within the Australian market, and I think it's going to come from places which haven't been obvious. For example, I'm not going to go there. I'm just seeing a few trends develop on things like industrials. I'm going to leave it at that point, and I'll pick up the stronger sectors if we have a fall and when we define a bottom. It just hasn't happened yet, so I just don't want to get too ahead of myself thinking I know what's going to happen. It's just too early. Just coming across to the daily on industrials. I'll stop there. Okay, so if I was to trade to the downside in this market, the most opportunity, as I've already mentioned, is in the consumer staples in the United States, and the reason being it's a weaker sector in a potentially weak market. Therefore, and consumer staples has been weak in the US for days, weeks, and months. Therefore, we should start looking at some of these stocks, and we should be looking at W patterns that are confirmed or M tops that give us an idea that we have a potential trade. And we could put up this particular stock, which is Coca-Cola, which has done a classic confirmation of an M top and is going up, and probably will go up, but if it fails to break above its previous swing high and fails, you've got yourself a classic MA pattern, which would be just a brilliant trade. I could go through all of these, which I'm not, because I did quickly look at a lot of them, and they're not all projecting beautiful patterns, and takes a bit of artistic license to do M tops on some of these stocks, so I'll leave that to you. But Coke was just one perfect pattern, which I saw. Most of them, though, are in strong downtrends. Procter & Gamble, and they're having retracements, so you don't have to have a perfect M top to take a trade. You just need a rally, and you need the failure of that rally as your trigger point to take a short trade. Why? For those people that have forgotten, why the weakest sector? Because the weakest sectors in the market have the biggest drops. If you trade the strongest sector, like tech, they will have pullbacks, but they won't be anywhere near as deep as the weakest stocks in the weakest sector. Okay, I've made that point hopefully many times before, and I'll leave that to you. Okay, let's go and track over to currencies, gold, oil. Let me pick up, first of all, the Australian dollar. We are well aware of the larger trend within the Australian dollar. There is there's a very big time frame trend, and there's a smaller time frame trend. And Blind Freddy can see that in the last few months, we've been watching the Australian dollar in a downtrend, and increasingly, it has been supported by an increasing level of institutional selling volume, and that has not ceased. There is nothing to indicate anything other than a downward trending market and a continuation of that move, which is good for me. Okay, I'm just getting rid of some stuff on screen. I just want to get rid of that trend line, that 200 period. Okay, but yes, we can see it's obviously trending down, but there is we need to put it back into the context of the larger move, and the larger move is up. So you could almost use this chart to have a hedging program for your currency exposure if you wanted to. I just don't. I can't be bothered. It's too much work. So for this market to continue that trend, obviously we'd expect institutional buying volume to kick in on the lower trend line, and we'd expect to see the evolution of accumulation via pattern and price. Okay, that's fairly clear. So if FXA is going to the upside, down in the near term, up in the larger time frame, we'd probably expect similar reactions if we come across to a daily chart of the US dollar. If FXA has been going down in the short term, daily time frame, we'd expect the Australian dollar to be, the US dollar, get it right in a moment, the US dollar to be going up, and that's exactly what we're seeing. So we've got the US dollar tracking up on a nice trend line, hasn't broken the trend line, but it also is approaching something of significance, and the significance is putting this now back into the larger context, that is the weekly chart. It's been in a strong downtrend, and it's getting close to its upper boundary. On that upper boundary, we would expect the reverse of what I just said on FXA, that is, institutional selling, volume, M tops, breaks of trends, and all those things that constitute a technical top for the continuation of the next fall. If US dollar's going down, sorry, I'll say that again. I've got to come back to a daily chart. So I'm talking in the daily chart context. If the US dollar's going up and the Australian dollar's going down, where's gold going? Well, it's usually inverse to the US dollar. So if the US dollar's going up, gold, in the short term at least, should have been tracking down. It's not a perfect relationship, but generally is true. As we come to this chart in the last week, there was a huge break to the upside on this chart, and it's fallen away in the last 2 nights. So it's a little bit uncertain which way this is heading. I think the best thing to do with this particular contract is bring it out to a much larger time frame, and we can all see that the trend of gold, as we know, we've been watching it every week, is up, and it's a low momentum, sluggish for years contract moving to the upside, and it looks like it'll head to its lower boundary. So the break that we saw last week is probably a bit of a false break. I think it'll go down to its lower boundary. On that lower boundary, that's just repeating myself, that's where we would look for technical accumulation by a pattern, moving average, institutional buying volume, and all those things that constitute the trigger for a buy. Happy with that? Let me go across to energies. Energies are interesting because I pointed out last week the disconnect between general energy contracts and oil. When I look at the XLE to start with, it has been extremely weak. Let me just bring it to a daily chart. Coming up to XLE, it had a huge fall into that February crash. Well, it's not a crash. Into that February corrective phase, and then it's just gone sideways. And that sideways is its inability to get any momentum to the upside. Could we call this an M top? Yeah, I suppose you can call it whatever you like. It's pretty rough to look at. But I suppose it's done a lower high and hasn't broken to the downside. So energies has been going nowhere in terms of the energy complex, but then we need to compare and contrast that against Texas Light Crude, which has been going everywhere and is developing a strong uptrend. When I look at the volume behavior for Texas Light Crude, it's so confusing because there's a massive shift in positive buying behavior for Texas Light Crude, and the reverse, a little bit muted, is there for the energy complex chart XLE. So this is like an industry within a complete sector is doing something which is not in synchronization with the whole sector. Is that unusual? No, it's not. I've mentioned this before. You've got 4 industries of banking, they don't all move together. You can get one that does something completely different. In our market, it's usually REITs operate completely different to the other industries of the finance sector, which are banks, diversified financials, and insurers. So what have we got here? We've got a market which is going to the upside. It's done a lower high. The lower high has been confirmed, and it's coming back to its trend line. Volume-wise, it is well supported to continue that trend to the upside. That's it. So that's an anomaly, but it is what it is. It's looking okay. I haven't bothered with sector rotation charts tonight. Alan just mentioned it's in a head and shoulders pattern. Before I just jump too quickly, Alan, and miss all your good stuff, let me just come across to XLE. Now I see what you see. Okay. I talk so quickly, I miss out on the good stuff. Alan just pointed out that he sees a head and shoulders pattern on screen. I think it's reasonable to see that as well. It's fine. There goes the head. We've got a right shoulder, and here goes the left shoulder over here. That's absolutely fine. And we can draw in a neckline. Neckline has not been broken, but it will probably be broken. You can do projections to the downside. The depth of the pattern from the shoulders to the top of the head, you can project that to the downside, and you've got yourself a target, but I'm not too concerned about doing any projections, but thank you for that. It's interesting. Okay, I didn't bother with any relative rotation graphs tonight. I just am not super interested in what's what in terms of upside, so I haven't bothered making any commentary. What I am interested in at this point, if the market's going down, is what is the weaker sector. And I can tell you that the weaker sector is actually utilities, but because utilities often, as has already been mentioned, stabilizes and a downward market goes up, I've just disregarded it. And the second weakest sector in the US market is XLP, consumer staples, already talked about. Coming across to the Australian market, what's the weakest sector in the Australian market? The weakest sector in the Australian market, I'm going to again ignore utilities. It would be property trusts and telecommunications. They would be the two weakest sectors. Let's finish by just having a look at a chart of those two general sectors. And first of all, look at property trusts. Now, they look pretty horrible. They look like they're in a process of failure at this point in time, again. And look at telecoms, my least favourite sector in Australia and in the US. It's taking a while. It's just horrible, horrible, horrible. Just in a strong downtrend, and probably will continue to be so. Guys, I think that's it for this evening. If there's anything of major significance that happens before we meet next week, I'll send you out a snapshot recording, which I did last Friday. But it's Easter, nothing's going to happen. So just have a great Easter. Take it easy. Stay off the roads if you're drinking. And I look forward to seeing everybody the same time next Thursday. Good night.